Climate tech innovation is everywhere, but if you talk to startups, it's not the product that keeps them up at night. It's the financing. The difference between success and failure is often whether or not you've gotten enough financing to turn your initial pilot into a scalable business. Having run a startup that raised VC, I'd venture to say that finding the right financing partners is almost as important as finding the right life partner. You're stuck with them for the long term, baby. And when I started my company, I was eager to understand the funder mindset. How do they think? And you can hear their advice directly in this conversation. I'm excited for you to meet the highly respected investors in this conversation, which we recorded at the recent Yale Clean Energy Conference. First, there's Amy DeFore. She's a co-founder and general partner at Azola Ventures, whose initial fund of $239 million blends philanthropic and private capital to invest in early-stage climate tech companies. Next, you have Terry Kellogg, who's a managing director of Helios Climate Ventures, which has invested $200 million in all sectors of climate tech, especially energy storage. Lastly, we have Rakesh Shankar, who is the partner of Next Gen Investments at Anton Infrastructure Partners. They're a private equity firm focused on infrastructure with over $33 billion in assets. I love these investors because they offer your candid takes on this moment when clean energy is losing policy support, at least in America. They don't sugarcoat the realities and the challenges of this work, and they even give you some career advice. Together, we explore these questions. Can climate tech scale without government support? What does the next era of climate tech look like? How do you make decisions in these uncertain times? These experts each work at different financing stages, and they've seen climate tech go through a lot of phases. Let's talk about these phases real quick. You'll hear us talk about climate tech 1.0, often called clean tech, in the first 10 to 15 years of the 2000s, where the focus was on novel hardware and first-of-a-kind tech like solar manufacturing and fuel cells and advanced materials. And there were a lot of high-profile failures during this time because that tech was capital-intensive and they had longer than expected deployment timelines. Then came Climate Tech 2.0 the following decade, where climate capital looked to fund asset-light, software-enabled technologies. Things like energy optimization software, carbon accounting software, marketplace business models. People made money, but it didn't exactly transform industry. There are a lot of hard to decarbonize sectors that didn't get touched. And now we're on the brink of Climate Tech 3.0, in which costs are falling precipitously, and these next generation technologies are now a matter of national security and industrial policy around the world. Stay tuned for the whole conversation to learn more. In a future episode, we'll break down climate tech financing trends in more detail. And until then, welcome to Future in Bloom. So many of these climate tech companies are deeply affected by policy on multiple levels, from interconnection and permitting to transmission to creation of demand. You look at one of the most golden child companies in climate tech like Fervo, a lot of how they were able to get their contracts with big names like Google is they had a law change in California that mandated that utilities buy baseload power. And so I think, though, we sometimes can diminish the importance of policy in the investment side because we don't want to scare off LPs from our industry.
I got to say, I don't think there's any way to invest in clean energy, at least certainly not at the bigger stages, without taking a policy point of view. I mean, we all say we want to avoid it. We don't want to be reliant on it, which is totally true. You are exposed to it, to your point. There's just no way outside of it. Part of it is because the economics of these projects aren't where they need to be, and there's always a desire and a push to have other kinds of support to make the economics work, and typically that ends up coming from the government. But the other side is behavior, right? One of the challenges we've seen through in Climate Tech 1.0 and Climate Tech 2.0 is adoption of these new technologies, primarily from commercial and industrial customers, is very slow. It's very slow, and it's very long. And more companies will go bankrupt in its process of going from its second customer to its fifth customer than in sort of getting that first customer, right, or the second one. And behaviors are just very sticky, especially in energy and infrastructure sectors where you do have large incumbents and you've got people who've been doing business a certain way. What policy does, of course, in many ways is change that behavior. So it's not just about, I'm going to give you a tax credit or I'm going to give you a certain dollar per watt that's going to come to your bottom line. it encourages people to take some of those behavioral changes, encourages CPG customers or industrial customers to go out on a limb a little bit to take a bet on a smaller company and help them get to that scale. When policy goes back, not only have you lost that direct support, I find you lose that indirect support. You lose that willingness of the other participants in the ecosystem who we need to lean in to actually make some of these projects work. They end up taking a step back, and you've lost a lot of the gain that you've had in the last cycle. And so we'll have to see how Climate Tech 3.0 evolves, but that's the place where I'm looking at, is to see how does the private sector step up, because they stepped up to take advantage of all of the government largesse that was coming around, and they were out the door, and they have been out the door very quickly as soon as all that dried up. Let's see what the big industry says now.
I mean, the question centrally is that gets asked again and again, is AI good for climate or bad for climate? And I find that question to be irrelevant, because we don't know yet. We shape the future. We create the problems. We need to solve it. We need to figure out how to use AI to help climate. It's not a done deal. It's not a preordained destination we're heading to.
And if I could just build on that slightly, because I'd say, our biggest position now is in a battery company that serves directly the data center market, and the battery provides backup power to these data centers and is particularly good at servicing the needs of AI. And what's fascinating from that vantage is to see the impact of all the pressure on load growth associated with AI. And what that means directly right now is essentially the value associated with solving these problems is now higher than it's ever been. And so therefore the opportunity to solve these problems of optimization and efficiency and behind the meter solutions and microgrids is now finally front and center on the largest stage. Instead of 25 years ago when I was on your side of the auditorium, we were talking about it as if it were a dream.
So for us, the technology does need to be relatively buttoned up. The first commercial project needs to be relatively buttoned up. We don't take those kinds of risks. And we rely a lot on third-party advisors as well as our own internal operating advisors to help us figure out exactly where in a new product's offering the risk lies, whether it is in the technology or the commercial adoption or regulatory policy or some of these others. So for us, a big part of it is making sure that the pipeline is real and the contracts are real. But fundamentally, and I'm actually very curious what you all think about this as well, even in the infrastructure or the heavily institutional sectors, I find that it often comes down to management teams. The best way you can de-risk a business is making sure you've got a highly credible and frankly agile management team that's able to roll with the punches, because there will be punches that come along the way. And the businesses that I've seen, even in our institutional framework, not make it are typically ones who are just too rigid or not able to move with the times. One, don't be afraid of the cycle, right? There are going to be cycles. No matter what sector you pick, no matter what time you sort of graduate, no matter how you get into this sector, there are going to be cycles that you're going to have to deal with. So if you're afraid of getting into a sector because you feel like it's a down cycle, or if you're excited to get into the sector because you're like, well, this is a good time to do this, that's probably a bad reason to do it. Like, don't do it because it's hot. Don't not do it because it's cold. And cycles are going to be part of whatever you get into. So just you have to sort of, what you should spend time on is really figuring out what it is that you like about what you want to do, and then go with that.
Great. And so we're going to do a quick lightning round just so you understand where each of these investors sits in the spectrum of capital. So talk about really quickly what stage you're investing in. You mentioned it briefly, Terry. Do you want to start?
Yeah, I'm happy to start. We invest in much later stage companies, so we typically do control investing. So we have majority stake acquisitions in businesses, typically post-revenue. So I'd say Series C onwards, once they have revenues and are close to EBITDA positive.
Perfect.
Earliest stages, so spin out of university labs, usually first check into a company, pre-seed, seed, and Series A, typically.
At our founding, we really focused on Series B, and one of the reasons we like that is we had a double PhD on staff as a partner in physics, chemistry, mathematics. He had deep battery expertise. So we could come into deals, we felt, with a lot more technical expertise than most of the other funds, and we had a higher degree of comfort, therefore, getting in pre-revenue pre-major purchase order, et cetera. But over time, we found that, as I mentioned before, one of our strengths is the flexibility. So the ability to follow that company through C, D. We just did an F, and which is essentially the pre-IPO round.
Where do you get your capital from, and how does that change what success is defined as?
I'm happy to start. So that 200 million plus from us has been primarily high net worth, family office, and a sprinkling of foundations. And I have to say it's been the most wonderful part of the work for me is developing the relationships with those LPs. They are not faceless institutions that we intersect with. And when we talk about the progress of the deals, those conversations are much more multifaceted because they involve the basis of a shared set of values and purpose, and of course also the traditional investment metrics as well.
So Zola Ventures is an impact first fund, and we're really guided by our North Star of climate impact. So our LPs are typically foundations. We have some of the largest foundations in the United States, high net worth individuals, family offices, and we also have a few corporates. I would say similarly to Terry, we really want to create long-term relationships with our LPs and partners. We don't think about this as just capital. It's really about trying to drive forward some of the climate innovation and also where we feel like investors aren't really paying attention to in sort of the clean energy and climate space. And I think because of our relationship and because of our LPs, it actually drives us to really be very laser focused on overlooked and neglected solutions in the clean energy and climate space.
We look exclusively for faceless institutions to invest in ours. Almost all of our money is pension and endowment money. About 2/3 of it is from European pension funds, and the remaining third is U.S., Canada, and the rest of the world.
Yeah, and can you all talk about the relative difference in success definitions and time horizons based on the differences in your LPs?
Our fund is actually a 15-year fund, and we are primarily investing in hardware-based companies, although not exclusively. Why? Hardware is hard. It requires often a longer investing horizon. It's much more capital intensive. And so we believe that, for us, we want to invest in companies with capital that we feel like much better matches the risk and reward profile. For us, in terms of what success looks like, is a company, being on the pathway or achieving, gigaton scale climate impact. As mentioned, that's really our North Star.
The reality is, if we want to do more of what we're doing now, we need to demonstrate that we're delivering metrics on par with the other investment opportunities that are available to them. And so we rarely, if ever, have had a conversation about concessionary returns, would be the buzzword for the notion that it's okay to take longer or, deliver sub-market rates.
Can I say one quick thing to Terry? Sorry for jumping in.
No, this is great.
Yeah. Most venture capital funds actually don't return capital in 10 years. They typically return capital in 12 to 15 years. So there's also, I think, for particularly depending on the types of companies that they're investing in, there is a narrative that's being told that isn't always as matched to the truth. So
why do you think that is?
Because LPs, want to hear that they're getting their money back faster and quicker, even if that may not necessarily be the case, or they need to have a better understanding of the types of funds that they're investing in and the risk profile. Like sometimes stuff takes longer.
Okay, so now that we've grounding and where you all are and how you invest, your thesis, let's talk about this moment that we're in. The $1 million question. How are you approaching this moment in terms of capital deployment and policy, and how has your deployment changed in the last year?
I'm happy to start. I'll first say, just in terms of policy, we really try to be policy agnostic. And what I mean by that is we're never going into a deal thinking, oh, great, there's public support here. That might help us in the end. The investment we're looking at has to be able to stand on its own regardless of of changes. Although of course we benefited when the support was there, and we've been hurt, when it eroded. Still, it's not part of our philosophy, approach, thesis, or strategies. In terms of the moment and how we are operating, I mean, I think first it's probably worthwhile to perhaps define the moment. And from our perspective, we really are looking at the end of Climate Tech 2.0 and the beginning of Climate Tech 3.0. And if we think about 2.0 broadly, I mean, we can draw themes like essentially free money, extraordinary growth stories, milestones such as Tesla becoming the most valuable car company in the world, solar becoming the lowest cost way of generating new electricity for 2/3 of the world. I think that happened as far back as 2020-ish. And you can go on through that list, right? And so we had, out of the wreckage of 1.0, the ability to fundamentally bring to scale all these technologies that we've been hoping for so long. The next iteration, in our mind, is going to have much more to do with capital efficiency, integration. We're looking at more and more the software side. I don't love this metaphor, but I think it's interesting to play around with the notion that the first stage in the internet evolution really was, it was fiber, it was switches, it was routers. There were names like Cisco and Lucent that we don't hear as much about anymore because we hear about Google and Facebook. It was the applications that were built on top of that infrastructure, that ultimately grew to provide the services that we all enjoy and rely on today. So again, not a perfect metaphor, but one that we think about a lot as we make choices going forward.
We focus on companies with freestanding economics, minimal reliance on policy support or government subsidies. So if we get somebody's model and they've got, a line that, inflates their economics because they're reliant on some policy, the first thing we do is zero that out. We think that's just being kind of very, very sound. This is a really unique moment. I think there have been two things that we've been thinking about supporting our companies in this moment. One is that, in 2021, 2022, and there was so much capital that was flowing into climate more broadly and clean energy, a lot of investors, at least we felt, were really focusing on managing their portfolios and particularly management teams to be fundraisers only. And that's not the right way, in our opinion, to build a strong, self-sustaining and impactful business. You need to be an operator first. You need to be focusing on business fundamentals. So I think that's one of the areas that we've been really drilling down into our companies. The second is about the financing risk across different sort of financing stakeholders. So if in 2 years ago, when you're building a syndicate, the first port of call is a bunch of other climate tech investors. That's really not what we should be doing. We should really be building diverse syndicates that aren't dependent on climate tech or clean energy. So are you bringing in sector specialists? Are you bringing in geographic specialists? Are you bringing in generalists? Because downstream, when capital has been constricted, aside from, companies that are focused maybe on power because of, the demands from AI and compute, you've at least diversified the ecosystem of investors that you can go to. And so we think that helps, mitigate risk for a lot of the downstream financings from some of our portfolio companies.
My fund is the Next Gen Infrastructure Fund. When we set the fund up about 3 years ago, the big question for us was, do you want it to be an energy transition fund or a Next Gen Infrastructure Fund? And they're obviously very different mandates. And 2-3 years ago, as everyone recalls, next energy transition was the thing, right? Everyone wanted a piece of it. 2.0 was in full swing. And we had made the decision to be a next-gen infrastructure fund, which has a broader mandate than pure energy transition. So invest in energy, but we also invest in recycling, in waste, in carbon, transportation, digital, some of the other infrastructure sectors that gives you a much broader mandate than purely sort of clean energy. And so candidly, that's where we're focused on right now. A big part of our focus now, partly because we have several renewable assets in our and renewable energy assets in our portfolio already, and we want to make sure we have a diverse portfolio of different types of assets. We're spending a lot of time in waste to value, water, carbon, than we are in renewable power, because that's kind of where the opportunities are right now.
I hear all of you that you want to make sure your investments are as impervious to political and policy volatility. But I think there's also the fact of the matter is so many of these climate tech companies are deeply affected by policy on multiple levels, from interconnection and permitting to transmission to creation of demand. You look at one of the most golden child companies in climate tech like Fervo, a lot of how they were able to get their contracts with big names like Google is they had a law change in California that mandated that utilities buy baseload power. And so I think, though, we sometimes can diminish the importance of policy in the investment side because we don't want to scare off LPs from our industry. And I think it is one of the most important pillars.
I got to say, I don't think there's any way to invest in clean energy, at least certainly not at the bigger stages, without taking a policy point of view. I mean, we all say we want to avoid it. We don't want to be reliant on it, which is totally true. You are exposed to it, to your point. There's just no way outside of it. Part of it is because the economics of these projects aren't where they need to be, and there's always a desire and a push to have other kinds of support to make the economics work, and typically that ends up coming from the government. But the other side is behavior, right? One of the challenges we've seen through in Climate Tech 1.0 and Climate Tech 2.0 is adoption of these new technologies, primarily from commercial and industrial customers, is very slow. It's very slow, and it's very long. And more companies will go bankrupt in its process of going from its second customer to its fifth customer than in sort of getting that first customer, right, or the second one. And behaviors are just very sticky, especially in energy and infrastructure sectors where you do have large incumbents and you've got people who've been doing business a certain way. What policy does, of course, in many ways, is change that behavior. So it's not just about, I'm going to give you a tax credit or I'm going to give you a certain dollar per watt that's going to come to your bottom line. It encourages people to take some of those behavioral changes, encourages CPG customers or industrial customers to go out on a limb a little bit to take a bet on a smaller company and help them get to that scale. When policy goes back, not only have you lost that direct support, I find you lose that indirect support. You lose that willingness of the other participants in the ecosystem who we need to lean in to actually make some of these projects work. They end up taking a step back, and you've lost a lot of the gain that you've had in the last cycle. And so we'll have to see how Climate Tech 3.0 evolves, but that's the place where I'm looking at, is to see how does the private sector step up, because they stepped up to take advantage of all of the government largesse that was coming around, and they were out the door, and they have been out the door very quickly as soon as all that dried up. Let's see what the big industry says now.
And I'd love to hear all of your thoughts on how you're mitigating risk right now, either specifically given the moment we're in Climate Tech 3.0, and for your stage. For instance, on the infrastructure side, infrastructure investors are starting to take bets on technologies that seemed too early years ago, like hydrogen. And so how do you assess risk when you're making your investment decisions?
Our mandate is not to take technology risk. It's very much to take scale-up risk. So we don't want to do first-of-a-kind projects, but we're happy to fund second to fifth-of-a-kind projects to keep things scaling up. So for us, the technology does need to be relatively buttoned up. The first commercial project needs to be relatively buttoned up. We don't take those kinds of risks. And we rely a lot on third-party advisors as well as our own internal operating advisors to help us figure out exactly where in a new product's offering the risk lies, whether it is in the technology or the commercial adoption or regulatory policy or some of these others. So for us, a big part of it is making sure that the pipeline is real and the contracts are real. But fundamentally, and I'm actually very curious what you all think about this as well, even in the infrastructure or the heavily institutional sectors, I find that it often comes down to management teams. The best way you can de-risk a business is making sure you've got a highly credible and frankly agile management team that's able to roll with the punches, because there will be punches that come along the way. And the businesses that I've seen, even in our institutional framework, not make it are typically ones who are just too rigid or not able to move with the times. And so to me, the best way to de-risk a business, even on our scale, is making sure you're following a management team that actually can show that it can move.
Yeah, Amy, on your end, Azola is known for deep decarbonization venture capital, and that means taking science-based technologies and determining whether they should stay in a lab or they should be commercialized. So how do you make that decision and think about risk?
If we're going into a university lab and we're thinking about supporting founders to spin out a technology, I think to make sure that it's ready for venture capital, because not everything in a lab is ready for venture capital. We often will ask, like, why now? Like, what will venture capital dollars help you do that maybe grant dollars or other forms of non-dilutive funding won't be able to? We think it's really important that founders have a really crisp answer to that, because otherwise you might be better off continuing with non-dilutive funding or maybe reaching out to angel investors and not really an institutional VC fund. Before, I joined our team and we launched Azola and our predecessor Prime Impact Fund, I was a renewables investment banker. And so I don't get that excited by just novel technology for novel technology's sake. Like, what do the unit economics and do the techno-economics look like? Because there are a lot of really interesting technologies that are just sitting on the shelf and that won't cut it. So when we're talking to founders at that stage, like, have you done some basic modeling for unit economics? Do you have a sense of what some of the potential most sensitive sort of drivers are, like, in your model? And, like, do you have a glimmer of a business model? It's okay if you don't have everything figured out, but you've got to, like, have some at least, like, credible pathway so that we can then stress test through like our initial investment.
Mm-hmm. I'll try to come at this from a slightly different angle and just sort of look at the market as a whole and the evolution maybe from the peak of the froth of 2.0, right? So at that point, if you're a member of the Tesla founding team, so you could check the team box, and you had an idea and you sat down with the right investor, the person on the other side of the table could say, well, how big a check would you like today? And then you could see that really move quite decisively over, the course of the maturation of 2.0 and the downside of 2.0. Then it became, I at least want to see a pilot in the lab. And that was a basic requirement for us always and ever. But then it became commercial pilot. Then it became purchase orders. Then it became revenue. And increasingly now, I would say it is, clear path towards profitability is where the most significant dollars are. From, I would say, the Helios standpoint, over the past year, the way we're dealing with risk is really, adding more structure to the investment vehicle itself, right? And so when everything was up and to the right, it was all equity. And then we had the convertible notes come in because nobody wanted to price down, what they were really hoping was on the way up, but at least you could put money in on terms that gave you some downside protection. And then these days, there's just more bells and whistles out there. There's liquidation preferences, there's interest rates, there's warrant coverage, and sometimes it's a Christmas tree of, all of these things together.
Have you found that it's easier to get those terms given founders are more desperate for funding now?
But I would certainly say on average, founders are having to accept a lot more structure right now, even for very promising deals, with revenues, with big names, with compelling stories, growth trajectories. It's out there for sure.
Since you invest from startup stage to growth stage and you have that flexibility, what are the biggest constraints from, say, Series B to full commercial scale that your companies are dealing with?
Yeah, it's a great question. And really when you say the word constraint, I hear valley of death, right? And we all know that is a thing in venture. And as I reflect on, the arc of time here, I think, the question becomes, has that valley shifted? Has it gotten bigger? Has it gotten smaller? Right now, again, on average, I'd say it's bigger than we've seen in the past, say, 5 years for most companies. And yes, there are exceptions to it. But so often it's like, how well have you managed, the human side of the fundraising process?
And all three of you have mentioned this human side as being so important in how you pick companies. And in the multiple rounds and millions of dollars that I raised money, not a single investor in due diligence ever asked me, how do you treat your employees? How do you retain your employees? It was always about TAM and, what are your unit economics, all of which are important. But to your all's point, if you can't run a company with good business fundamentals and retain your best talent, your business isn't going to be successful. So can you talk about ways that you think investors could help their portfolio companies do this better?
When we invest at companies, they're usually not a company really yet. They're like 2 or 3 founders. So after our capital's coming in, it's when they're first hiring a team. I think one of the things that we talk to our founders about, pretty regularly is building a strong culture. From our perspective, that often is around like treating your employees well. It's around hiring the best employees, which don't always mean that they're coming exactly from your networks. Like, be broad, be thoughtful about who you're trying to bring into your organization. Having 3 founders is very different than having 5 people, which is different from 10 people, which is different from 20 people. So at every stage of growth, you may need to reevaluate and understand, we've given you millions of dollars and we're not running an academic lab. We're hopefully turning this incredible technology into a business that will have so much climate impact and will do so much good for the world. And trying to marry those 2 objectives can sometimes be a tension and a challenge, because it's just a very different way of thinking, depending on a founder's lived experience beforehand.
Yeah, if I can. Well, first of all, it's presumptive to think we can actually help them, because, to be clear, I've never started a business and I probably never will. So I think part of it is also knowing that, there's things we can help them with and things we can't. I mean, there are things that they're good at because they've got the ability to be a founder and do that. For us, when we still invest a lot in founders, they're just further down in their path, right? So when we invest in companies that are typically better established, 80% of the companies invested in still have founder CEOs, right? They've just been at it for a little longer, and so they've been there for a while. One of the first things we ask them is, have you been through a downturn? Have you fired people? And how did you manage that, right? Because that does tend to be important. It's great. It's all good when everything's going well, right? And a lot of people can talk about that growth story, but if they haven't been through a down cycle where they've had to terminate or go through a riff round for their own employees in their shop, and typically these are friends and family. The other thing that we've started to do a lot more now that we didn't used to do before is, and there's a lot of asterisks around this, but we do actually now formally hire management assessment firms before we make an investment. Typically what we used to do is we would make the investment, and then within the first 100 days of making the investment, we bring in an outside management assessment consulting firm who would basically interview and create a report on the different management team members, strengths, weaknesses, do they work together. And like all things, there's benefits and disadvantages to reports like that, but it does give you useful data. There's useful data that these consulting agencies and agencies can provide you that help you give a little bit of a framework for how people are. We've started to do that as part of our investment process before we make an investment now. So we try and evaluate the team, not just who they are and how they work together, but where the big holes are, so that almost all of our business plans require a lot of growth. We know that if this plan needs to be hit, they need to fill these 3 or 4 holes within the organization.
So imagine you're going back to your earlier version of yourself, entering investment world in clean energy or climate tech. What advice would you give your younger self?
I think that a lot of venture capital firms are quite small, so they often hire people with sort of 2 broad archetypes. Either you know finance, which in many respects means you worked in investment banking or you worked in venture beforehand or private equity, or like insert something that means you know numbers, or you're a subject matter expert in a particular climate or clean energy area. So if you're a subject matter expert, then someone only needs to teach you finance. And if you have the finance background, someone only needs to teach you like clean energy and climate. I think another thing is be specific. I felt like when I was in business school, you always want to be really flexible and say like, oh yeah, I'm really open to anything. But like actually not being specific is so not helpful, because, we get so many emails, which is, I am so-and-so and I want to, learn more about your experience, co-founding Zola Ventures. It feels very generic, but the ones who are specific, like I still remember, this guy a couple of years ago was like, I'm really interested in biodiversity investing, huh? Like, that's so specific, kind of random. But when Superorganism, which is like the world's first biodiversity fundraise, I said, oh my gosh, I know who to connect you to. We can't be helpful and be a resource if you're everything to everyone. And so just having some specificity and also being pretty intentional about like what you're looking out of a conversation and not just like a general coffee chat, like I think would hopefully garner much more like constructive like responses and feedback. So that would be my advice to my former self. Okay.
Let's see. I don't want to sugarcoat this. I think the job market out there is probably hard, especially in our venture world. We were anticipating hiring an analyst, within the past 18 months, and frankly, everyone on my team now has a super analyst in their pocket in the form of AI, and it's becoming extraordinarily powerful. For example, the investment memo is a key piece of our output throughput as an organization, and AI couldn't be more useful, as a tool on a task like that. So let me try to be more helpful. I will say something I often recommend is, what you're ideally looking for is the best mentorship, is the ability to work with people that you admire and who are willing to take the time to impart wisdom upon you. And from my perspective, if things aren't coming easily, the idea of simply offering to get involved in what they're doing on a no-risk basis, and to see if there's alignment there, see if there's fit, see if there's a potential to add value is very worthwhile. I mean, my path, I'm not sure that there's anyone else who's gone from running a corporate sustainability program to running a nonprofit to then starting a fund. And so that would be the worst advice I could give anybody, other than to say, like, I did have a theory of change, and I knew what I cared about. I knew what I valued, and I was convinced that there was an opportunity somewhere at the intersection between business and environment for significant change. And because I was so convicted around that thesis and always thinking about, where is the biggest lever for me to pull, I've always felt like I've been in the right place. And so if you can develop that thesis, that's a recipe for, I think, at least, internal satisfaction.
One, don't be afraid of the cycle, right? There are going to be cycles. No matter what sector you pick, no matter what time you sort of graduate, no matter how you get into this sector, there are going to be cycles that you're going to have to deal with. So if you're afraid of getting into a sector because you feel like it's a down cycle, or if you're excited to get into the sector because you're like, well, this is a good time to do this, that's probably a bad reason to do it. Like, don't do it because it's hot. Don't not do it because it's cold. And cycles are going to be part of whatever you get into. So just, you have to sort of, what you should spend time on is really figuring out what it is that you like about what you want to do, and then go with that. If you talk to people that are in certain jobs, try to figure out what they think, what you think it takes to succeed in that particular job. What are the particular personality traits, character traits? What do you have to like to actually be successful there? And then be honest with yourself about whether you've got that.
What are the skills or personality traits needed to succeed? I mean, what would you say it is for your firm or broadly for your industry?
So I started my career in investment banking. Well, I started my career as an economist, then I was an investment banker, now I'm an investor. And those two have very different personality traits, right? What I really like about what I do now, and I think what we all would say as well, is that you stick with you stick with the investment that you make through its life cycle, right? I mean, you have to have a certain persistence, you have to have a certain flexibility, and you've got to be able to stick with something even if it's not going to plan. And you've got to live with it, and you've got to change your own mind about what is good or what success looks like for that particular investment over time, which is very different from a banking or maybe even a consulting point of view, which is much more transactional and service-based, right? You're working for somebody else. You're working to actually get a certain transaction across the finish line. Tends to be shorter term. The rewards tend to be a very different sort of reward framework.
we've made north of 30 investments, almost all of them. We've had a board director, board observer seat. It's like a marriage. It's long term. And if you don't like people, you probably shouldn't be an early stage venture, because you have to deal with people all the time. It's very social. It's very relational. I would also say at our firm, if you don't like to do different types of things, like if you want to spend time going very deep in a particular sector, it's also not going to be the right place for you, because we are climate generalists. So we're looking at all different types of technologies. You know, our model really always requires us to focus on sort of overlooked solutions. So if like all VCs are going one area, like we're looking, you know, at another area, we're kind of always trying to be on the bleeding edge.
When I was hiring in my company, I looked for people that had a growth mindset, people who were able to take challenges and just say, all right, I'm going to figure this out. I am not done learning. I'm going to continue to learn. We also looked for people who were not assholes. That's really important. And so picking your career based on not working with assholes is actually a valid strategy. And people who were incredibly competent. And so we were looking for these qualities, but if I were to look it back on my own career, and I think about students entering a really tough work environment now and think about how, if you want to be a venture capitalist, like one of the most popular professions, how would you break in? I would say just think about giving your time as a gift. Especially students have some time to explore what they want to do. They have time to give away their labor as a gift. It's a labor of love. And venture capitalists aren't going to hire someone unless they have some kind of experience or they come through respected referrals. Like you have to do something to build your credibility and your trust in the industry. And so often people get excited about things in the beginning and then their interest falls off over time. And the people that show up reliably do the work through the good times and the bad, and they play the long game, they end up being fine in their career. I asked you about your best investment. The human side of startups and entrepreneurship is not just the good times. It's the hard times. It's the hard lessons. So when you think about your career, what's a hard lesson you learned? You would have rather not learned it, but you learned it, and it's made you a better professional.
But I'd say the big part of the learning for me, of the mistake that I've made, that sometimes I continue to make, is frankly being fooled or distracted by people who are very good at communicating without actually going beneath the surface and seeing if they actually are able to execute what they say they are. Right? I mean, especially in our world, especially when you work with a lot of entrepreneurs in growth mindsets. There are a lot of people who talk a good game, and who can execute, and there are lots of people who don't talk a good game at all, but are execution machines. And it is still hard to tell the difference between the two. And every time I feel like I've got it figured out, I'm reminded that I don't. That this person who I thought is exceptional just totally whiffs, or this person that I thought, oh man, this person's not impressive. They don't know what they're doing. They just totally knock something out of the park in terms of execution. And so, constantly reminding myself not to get anchored in my beliefs about what a certain person's capabilities are based on their personality. To me, that's a constant learning that I've got to keep reminding myself.
One of the first investments that I made was into a company, and I was the director, and there was somebody else, another investor on the board, who was, in my humble opinion, quite not constructive, and was frankly, it was a distraction. And, you know, I felt like I probably let it go on longer than I needed to. And, you know, this investor and I had conflict. And it was unfortunate because the founder and CEO at the time was not only trying to figure out how to build, you know, his company, was also managing conflict between board members, which is never a good use of time. So one of the things that I did after that, thankfully, is that every single time I make an investment, and if there are other people sitting on the board alongside of me, if we co-lead, or even when we bring on independent directors, it's I will have my own one-to-one session, like we will go meet in person, or we will spend like 2 or 3 hours together, because that working relationship is so important. And we also need to broadly be in sync, because it is not helpful for a founder if they're getting 2 different pieces of information. And like, it's okay to have conflict, but I want it to be generative conflict. I want us to really have the time and the space to really challenge each other, but in a way that's not sucking up the founder or CEO's time. And so, I don't know, this has been like 7 years, but that's a practice that I founded. And honestly, just like you treat the relationship with a founder and a director as a marriage, it's a long, term investment. So that was a big learning for me.
It's really hard not to focus on this question of people. I had the time to tick through my head like how many of the challenges that we've encountered along the way in this portfolio of like 12 companies have been people related, and the answer is all of them. And the frustrating part is that it's the oldest rule of investing, but the reality is, when you're in it, it is incredibly hard. When you like everything else, and you have a sense that there might be a slight deficiency, but you think you can manage it, and maybe you're the one who can see beyond or know how to cope. Being early is fundamentally the same thing as being wrong. And this is a particularly hard one, because it kind of goes back to the earlier discussion we were having about subsidies and solar. In fact, this is a technology that would optimize the output from existing utility scale solar arrays. It's something that the industry desperately needs. It's solving an enormous problem, but the industry has been so focused on new build because of the subsidies. It's very hard to develop a whole new muscle. And that muscle entails changing how they think fundamentally about the business, never mind testing, validating, and then allocating the resources towards something like this. We will not be the ones to make money off this opportunity. Someone will.
And I appreciate your all's honesty, because, in panels like this, we talk about debt structures and financing at different stages. And sometimes we forget to talk about the human aspect of it. And that's what makes investors and companies succeed or fail often. And so with that, I'd like to turn to the audience and get your questions.
Since we are talking about clean energy innovation in this session, do you think major breakthroughs in clean energy that we can expect in the next decade are driven by social or grassroots innovations, or state-led large-scale national initiatives? And then how does that impact your investment thesis in different geographies? This is a general question.
At least in our line of investing, we're tending to invest where we feel like mainstream investors are going to look at in 2 to 5 years. So we made our first critical materials investment in 2018, a lithium extraction company called Lilac Solutions. Lithium, very critical for the growth in the electric vehicle market. Like, there wasn't a lot of attention there, but we were like, we think this is going to be, an issue. We feel like that's going to be an area that people are going to focus on. And so some of that tends to be bottom up, getting points of view from real problems that real people are experiencing, that sometimes are lived experiences of our founders and that they want to really focus on. And then other things are drawn, top down by where we're seeing, we can see like a gap in this marketplace, and people aren't focusing on it now, but we believe, they will be focusing on it. So even if I sort of take a step back, the question was about breakthrough technologies, but because I invest in companies that have the potential to reduce greenhouse gas emissions, we've always been focusing on carbon, but like methane and nitrous oxide are extremely important. And so that's an area right now that we're trying to dig into a little bit more, because, if we want to have a chance at, we've already blown past 1.5 degrees Celsius, but being on sort of a more quote unquote livable trajectory and buy ourselves some time, methane and nitrous oxide are much more potent than carbon. So we should be looking at those opportunities.
There's an extraordinary amount of innovation currently baked into the pipeline that we've been talking about here. And so even just with the current momentum that they have around developing product market fit, developing the capital that they need to exceed. We are apace to see some extraordinary breakthroughs in the coming years.
This is an interesting question. So is hiring an analyst more environmentally friendly than using AI to do the work?
Ooh, Terry, I think that's for you.
Has the most votes.
That's a good one. I'll take the tongue-in-cheek. And we have, in our portfolio, a bunch of battery companies that are very focused on using AI to optimize their product development. And the potential for the application of that tool around a problem like that, or the problem of fusion, or the problem of room temperature semiconducting material, in my mind, is going to outweigh the short-term dislocation that we're going to experience here. So I guess, fundamentally, I am an AI optimist, and I feel like it's a tool that we all need to fully embrace.
I mean, the question centrally is that gets asked again and again, is AI good for climate or bad for climate? And I find that question to be irrelevant because we don't know yet. We shape the future. We create the problems. We need to solve it. We need to figure out how to use AI to help climate. It's not a done deal. It's not a preordained destination we're heading to.
And if I could just build on that slightly, because I'd say, our biggest position now is in a battery company that serves directly the data center market, and the battery provides backup power to these data centers and is particularly good at servicing the needs of AI. And what's fascinating from that vantage is to see the impact of all the pressure on load growth associated with AI. And what that means directly right now is essentially the value associated with solving these problems is now higher than it's ever been. And so therefore the opportunity to solve these problems of optimization and efficiency and behind the meter solutions and microgrids is now finally front and center on the largest stage. Instead of 25 years ago when I was on your side of the auditorium, we were talking about it as if it were a dream.
Has anyone invested in fusion?
No, not us.
Yes. Guilty as charged. Very early stage. Lots of technical risk. It's a company called Avalanche Energy Designs. They're building small modular reactors.
And how long do you typically spend scouting or meeting with companies before deciding to invest?
Probably anywhere from 6 months. From when somebody first reaches out to us, or we first reach out, and even if somebody isn't raising, we want to get to know them. Part of that, at least for us, is because of our unique process. We tend to be counter-cyclical and make non-consensus investments, and that's where we believe there can be asymmetric impact and return. That process takes a little bit more time to make sure that we're really staying true to our mission of investing in overlooked climate tech solutions.
Yeah, never shorter than 6 months is what I would say. So almost 6 months to longer, just because it takes that much time to get to know a business, get to know what they're doing, and then decide if that's something you want to be a part of.
We have been in discussions of some form or another with this company for more than 2 years. And it's been fascinating to see their business model evolve, their thinking about themselves evolve. What I love to be able to do is start with the initial pitch deck that has all of the performance metrics and goals and objectives, and then check in another 6 months to a year and see how they're doing against those. So from our standpoint, as long as possible, to really get to know them is helpful.
I want you to talk about the unique opportunities you're seeing in this moment in investing. We talked about the constraints and obstacles, but what are the tailwinds that you are so excited about? I'm
happy to start. It's been echoed a lot today, but clean, firm baseload power. So, we've invested in nuclear fusion companies. We've invested in geothermal companies. We've invested in long duration energy storage. So there are a ton of tailwinds from the current administration. We also are excited about some of the critical materials companies, again, that we've invested in a very long time ago. If you ask me about where people aren't focusing efforts, like methane, nitrous oxide, iron, steel, rice, like decarbonizing rice, like food and ag systems, like more broadly, although I know that's not the focus of, the Yale Clean Energy Conference, but that's taken a really, really big hit from a funding perspective. So, yeah.
If we were to believe, which I do believe, that we will go through a phase of deglobalization in the next several years, to reverse some of the globalization that we saw over the last several decades, I actually am excited about the new types of innovation and improvements that will happen on the manufacturing side and the supply chain side here in North America. I think I've met more interesting companies that are making things here, making things in a more unique way, using interesting technologies, interesting processes, and moving products in a very interesting way here in North America now than I have at any time in the last, call it, 8 to 10 years. And I expect there's a lot of innovation coming. And human ingenuity and the innovation that really comes out of people when you put them into certain constraints is incredible. And so I'm really excited about innovations in American manufacturing and innovations in the American supply chain network that I'm pretty sure will be things that you've never thought would happen here.
Very simply, right now, on average, private markets have been challenging, but the public markets are obviously soaring. And so from a tailwind perspective, I'm going to try to pull from the story about the failed company, nearly failed company, maybe not failed if someone's got some ideas to pursue out there, in the solar optimization space. In our case, what we've done, to turn that up into an opportunity is it turns out that company was run by the single best CEO in our portfolio. And he's now joined us as a partner. And among other things that he did in his career, he ran Schneider Electric's data center business. And that's, to us indicative of, what we want to be doing more of in the 3.0 era is focused on kind of stack integration within a setting like that.
Hopefully out of this group, we'll get some grid optimization entrepreneurs as well in there. We need that pretty badly, as well as rice entrepreneurs. Thank you all for joining us.